Closing out June 2022, the market saw the second worst month of the year and the worst start to a year since 1970. Yikes. So let's find out what moved the markets last month. I'm Mike Salisbury, Portfolio Manager with Strong Private Wealth of Raymond James. Now that we're officially into summer, that means the first half of 2022 is behind us. And what a first half it was, with historic market moves to the downside not seen for decades. Equities, bonds, crypto, real estate, you name it, they all saw moves to the downside amidst growing inflation fears. In the month of June, we saw the S&P 500 down about 7.7%. The TSX Composite was down over 9%, and the Canadian dollar depreciated relative to the US dollar by close to 2%. All S&P sectors were negative for the month of June, with the cleanest of the dirty shirts being healthcare and consumer staples, and the worst performers being energy and materials. The overwhelming reason for these downward moves in the market is inflation and the roll-on effects that will occur in both the economy and capital markets with things like Federal Reserve rate hikes. Hey, speaking of which, remember last month when I said this? US Fed Chair Jay Powell has come out saying that he feels 2 more 0.5% rate hikes are appropriate. This is good news for the markets, as it takes the prospects of a single 0.75% rate hike largely off the table, making interest rate increases easier for both the consumer and capital markets. Well, that aged like milk. In the last month, Jay Powell and his friends at the Federal Reserve in the US raised interest rates by 0.75%, with the same 0.75% rate hike expected to occur on our side of the border on July 13th when the Bank of Canada releases their latest rate decision. These interest rate hikes are coming on the tails of red-hot inflation prints by developed country standards, with the US and Canada at 8.6% and 7.7% respectively, allowing sellers to really take hold of the equity markets. But there is maybe a light coming at the end of the tunnel. One of the data points we saw last month was the Bloomberg Commodity Index fell by 10.9%. Now, we're hoping that this translates well over to the Producer Price Index print coming this month. If we get a calmer producer price index, hopefully that translates into a calmer consumer price index. The difference between the producer price index and consumer price index is the producer price index, or PPI, is inflation that businesses feel on their input costs, and the consumer price index is what you and I feel when we go to the grocery store to buy a loaf of bread or fill up at the pump. Another data point we noticed is year-to-date, net inflows for global equities totaled over $200 billion, which means that a lot of investors still have a fair bit of confidence in the equity markets and that they will appreciate in the near term. Speaking of global equities, an increasing portion of that is China, which in the days leading up to filming this, we received some pretty good news out of. Even though the Chinese government is still bent on pursuing their zero COVID policy, they did mention that major cities like Shanghai and Beijing lately have seen little to no new COVID cases. This is a good thing, especially when coupled with them loosening regulation on their technology sector. These two things are widely seen as good news, not just for Chinese stocks that are currently seeing a rebound since going through a 34% rout earlier this year, but also for the global economy as a whole, as the Chinese consumer is now slowly coming back and buying more things as their economy opens up. If you like this video, be sure to hit that thumbs up button, subscribe to our channel, and hit that bell icon so you get alerts whenever we release new content. I'm Mike Salisbury, Portfolio Manager with Strong Private Wealth of Raymond James. And whether or not you are a client of ours and you want to know how this affects your investments, please feel free to reach out to us, because our job here at Strong Private Wealth of Raymond James is to help you live a life well invested.